All right, good afternoon, everyone. Welcome back to Wook Capital Management's 25th edition of our weekly Wook and Review broadcast. I'm Managing Director Rod Alsman. We're going to go through some of our prepared content today. It's a little bit shorter than usual, so we should get done with that in short order, and we can get through any and all topics that people want to discuss. It's been another busy week in financial markets. It was a busy week in my life. It was my birthday on Wednesday, so I am one step closer to the end. But I had a nice time. I do want to, before I get into the content, let everyone know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. Okay. So again, if you're in the Wook Discord server, you can follow my screen. I'll note some things that I have up on the screen, but it's obviously not required. Joe has the thread pinned, which has some of the links to the different stories and that we're going to go through. So, I mean, really, there's only a few. I mean, really, the bulk of the conversation today is on this ongoing bank crisis and where the Federal Reserve sits. So we're going to talk about the Fed's action and decisions this week. We obviously didn't get any incremental bank failures this week, knock on wood. And we'll kind of talk about maybe some of the inconsistency in what, for example, on Wednesday, the Fed chairman had to say and what the Treasury Secretary had to say and why the financial markets didn't like that. And yeah, I'll leave that discussion to the end. So going to get through the watch list companies first. As we've noted a few weeks now, we've got a Wookie watch list that we've put together based on the feedback of Wookiees, kind of a retail favorite heavy lineup, tech favorite lineup. We will continue to add and remove companies from this list over time, but let me get this correct screen going on. There we go. So we had a couple of earnings and major 8K events from two of those companies this week. So we'll go through GameStop. I know that Joe hosted on Wednesday the GameStop earnings call, which I missed for the first time in many years, being obsessed with the company since it was my birthday. But Joe, before I kind of go through with my take and open it up for anyone who wants to talk about it, how did that go?
Yeah, I mean, the earnings call was super brief, as to be expected. Like, literally, probably a 9-minute call. And then we had some spaces difficulties. It seems like Android phones couldn't connect to the space, which thanks Elon. But overall, I mean, the company was profitable, and people were enthusiastic regardless of no guidance or anything else.
So yes, it was profitable, and it was definitely a surprise. So we can kind of dig into what were the puts and takes that enabled that. Again, I'm just going to look at kind of the financials on my screen that I'm sharing, and obviously you're welcome to do whatever you'd like, following along or not. But there were two levers that they pulled. So the first lever is, look, they were actually down 1.4% year over year on a revenue basis. So the top line number came in at I'm looking at full year last 12 months. Let me look at quarterly. The revenue in the fourth quarter for GameStop was 2.23-ish billion, which was down 1.2% year over year. So revenue was down. All right, great. But there was a market improvement in their cost of revenues. So the gross profit for GameStop jumped from 16.7 or 8% last fourth quarter, which is absolutely atrocious, back into the 20s. So there was a huge expansion in their gross profit, which would be the direct costs of the toys, gaming hardware, gaming software, accessories, etc., that they sell to consumers. And with this one, you just really, I think, have to think about this from a longer term perspective. The goal of the company, I think, was to get, stop bleeding market share. First off, they had been bleeding market share, and I think that when they were able to raise so much capital from the enthusiastic shareholder base they have in 2021 after the January mania, um, they felt like I think they could use gross profit as the lever to try to bring back and staunch that market share bleeding. So their gross profit percentages had kind of gone through the floor until they troughed last fourth quarter. And part of that is the elevated freight costs that a lot of retailers were incurring. So that eating into the margins. But I think here, as they had noted a quarter or so back, that they've obviously shifted the focus to profitability, and not necessarily just to judge them on growth, on revenue, the top line numbers. So they gave up some revenue opportunity, but because they took margins up so much, it far more than offset that. So their gross profit went from 378 million to 500 million. So that's great. Now what? You have to then allocate all of your indirect costs, your leases, your labor, your corporate overheads, all of the SG&A. So year over year, the SG&A is up a little bit, but went from 440 million to 453. So last year, of course, that SG&A then didn't cover the 378 in gross profits. They were already operating loss. Here, they have an operating profit, and it's a almost a $200 million swing. It's almost a 10% swing going from where they were last year in fourth quarter to this year. So they've clearly taken a lot of cost out of the model. They've talked about the investments they've made in both fulfillment, in just getting the company up to 21st century capabilities. I'm not an insider. I've never been, so I don't have any deep insight into just how far behind the company was from a technology perspective. But the sense that this current management team, I think, is trying to convey is that there was a lot of investment and costs that had to be incurred trying to beef that up. They obviously then also brought a lot of people on board that they've now let many of them go. And Matt Furlong noted in the call that they're going to let more folks go, and they have in 23. So you should see that SG&A line item hopefully continue to trend either flat or downward. If revenues go up, hopefully flat. But it leaves them with a meager operating profit that they brought in the fourth quarter. And the fourth quarter is, of course, for them in particular, the best quarter of the year because they're a very seasonal business. They're not on the calendar year. Their fiscal year ends at the end of January. So their fourth quarter is the holiday shopping season, November, December, January. There's many retailers that operate on that period. So, I expect that they will likely still lose money in the first and second quarter, and it'll be interesting to monitor it. I think the reaction from the stock price perspective was pretty overblown, but probably a function of positioning. You probably had some folks who were betting that the losses would continue and felt like, well, that thesis was disproven. Let me close out of my short or whatever. When the stock rallied, what was it, 50-ish%, a little less after hours on the 21st, and it still closed the week up 40 some odd percent. So now it kind of gets back to what I've been saying for some time now, in my view, that at $7.25 billion market cap, I don't see a pathway for them to justify that valuation. There's clearly a lot of excitement from the shareholder base, and perhaps some of their, as management called it, pragmatic growth angles will end up paying off. Like perhaps NFT will come back into the vogue and not have just been a fad. There's a lot of uncertainty around if there's an opportunity for blockchain in gaming. Gamers, of course, spend many billions of dollars on skins in-game purchases that they're non-transferable. They don't really own per se beyond just their account has it. Um, so that's all though speculative to a large extent. That would be kind of the hopeful growth angle. At its core, you just have to look at still they generated a little less than 6 billion in sales, and I think in a best case scenario, this company gets to like a mid single digit EBITDA margin. So maybe they're generating, assuming flat sales, maybe they're generating 100, 20-ish in EBITDA back out. They are actually, because of the cash on the balance sheet, generating interest income right now, but that's not part of their operation. That's just part of the capital structure. So what multiple would you put on that? Let's say 120 million in EBITDA. I don't think you would put much more than a teens, for a retailer. So that gets you to less than a third of the current market cap, which would obviously be a meaningful drawdown from here. But um, there's still just a lot of uncertainty, of course, around how well they can function, and there's valid questions around what's the terminal value of the console business, which is still their core business, because will next generation consoles have disk drives, which was of course the question that we were puzzling over in the 2017-18 timeframe until it became obvious that they would. And as the record shows, some folks thought that the company was going to zero far faster than it would, and it blew up in their faces when they were heavily short and the stock traded at, a discount to the net cash position. So it's a good quarter. It's great to see them making progress on their cost takeouts, and that they've effectively been able to regain profitability, at least in their best quarter of the year, without forsaking sales. But the company noted, and I saw just yesterday, that they're closing their entire Irish business. So we know they're closing some of their European business, which for many years has been a money loser. And it's unfortunate, I guess, that they were not able to identify a buyer for some of these businesses. So it looks like they're going to wind down operations in some countries in Europe. But if you decrease the losses there and you take cost out, yes, your revenue will go down. But if your operating profit is going up, that's what investors want to be looking for. So I still think it's too richly valued. I think the reaction was a bit of an overreaction, driven by some people probably offsides on their positioning. It is still a heavily shorted stock, I think, for understandable reason. The cost to borrow has gone back up again, so it's not a cheap thing to be in. So the pain trade could be, flat or higher. Who knows, right? From an observation, I wouldn't find it in a level that would be attractive as a speculator to try and chase. But who knows? Anything could happen. I think there's not too much else to be said. They have a very short call. They don't disclose too much. I think that it's simply what they're telling us, that they're taking cost out. Look to their actions, not their words. They did succeed in taking cost out. And the question to me is still, can they ever justify the valuation?
Sorry.
No, it's fine. I'm done. So, if anyone wanted to chime in, had thoughts on the GME earnings, or wanted to discuss it further, anyone's welcome to come up and take the mic. Otherwise, we'll keep going.
Yeah, I'm just curious what happens at the next earnings when it's going to be a quarter one for GameStop. If they're not going to post a profit, are investors going to be disappointed, or could they keep up this momentum?
It's really hard. Yeah, it's really hard to say, because clearly there's a lot of people in the stock who aren't sophisticated analyzers of financial statements. They're more interested in waiting for the 10K to come out and show how many shares outstanding have been registered with the company's computer share agent direct registration, which the 10K, because they're a large accelerated filer and their year ended at the end of January, that means the K needs to be out by the end of March. So it should be out next week, it will be out next week, or they'll have to file an extension. But that was one thing I noticed. They didn't file the 10K yet, and there's a little bit more information that would be in there that we could glean. So there's not, I can't say everything about it just yet until we get that. But sick, what's up, man?
Hey, it's been a while. Happy belated birthday, yo.
Thank you.
And wow, I actually got the on my Android. I guess like they fixed the issue on this, but
Nice.
quick question. So with GameStop and the current macro environment, wouldn't like the macros have a bigger effect on the price of the GameStop shares, or is it still because it's trading like a token that like the valuation is still fundamentally disconnected from like what the actual value is?
I'm inclined to
Like, what's
lean
the
more
number?
toward the second part of what you just said. That, yeah, to some extent, what happens in the operating business does matter, and it should matter, and it over the long run will matter. But I agree with that notion that it largely is more of a trading token in the near term. And as we all know, trading tokens can trade anywhere, up or down. So I don't think that fundamentals are the primary driver. I do think over a long duration they are, and they're a secondary thing. But I think it was more that there was a lot of shorts that were caught off sides, and then with a this solid profit, but again they still lost hundreds of millions of dollars over the full operating year. So um, will they? How much will they lose in the first and second quarter? Right? They made a 180-ish million dollar improvement in operating income year over year in the fourth quarter alone. They lost 120 million in the first quarter of last year. How much will they lose? If they only lose, that they improve that by 80, 90, right? They could absolutely get to break even for full year 23. In fact, barring some meaningful deterioration in the economy, there's a very strong software slate this year. There's really not much sell side coverage of the company anymore, as many who've been following the whole saga know. Just in terms of looking at what the analyst estimates are, not that they're accurate or will prove to come true, but for full year 23, it looks like it's basically calling for revenue to again be basically flat at the top line. Basically zero year over year is estimated. So if you do get that improvement in profit from lower freight costs, them, as they noted, trying to negotiate better pricing with their suppliers, you could get a gross margin expansion. And if they're also doing a good job of rationalizing headcount, then you get the SG&E coming down, on flat sales. I think you could absolutely see them get toward break even. That's not what's estimated for the year. For the full year, it looks like I can see next quarter. Where do I need to go for that? For full year, yeah, they're calling it 24. Only one analyst even has an EBITDA estimate of the three remaining analysts, and they marked it at minus 62 million. So, yeah, just again, it's like, okay, if you're at break even, that's great. You've disproven a bankruptcy imminent thesis for sure, given that your balance sheet has however much the net cash is now. It's meaningful. It's over $1 billion still, I think. But what is the company
I
worth?
think like 1.4, right? Gotcha. Thanks for that.
Yeah, sorry. It was I. They show the wrong year. It shows like full fiscal year 23, even though it's really 22 in some places. So that just keeps throwing me when I'm looking at these dates. Um, but yeah, their cash balance, of course, is high at the end of the fourth quarter because they just sold through their holiday inventory. Their inventory exits the quarter at the lowest level of the year. Um, well, who knows? It remains to be seen how they're going to operate this business. I think they could actually draw inventories down further into the first and second quarter a little bit further, depending on how
I mean,
things
like
go.
the other thing like the other thing I kind of wanted to bring up right now, like they're factoring in like the freight costs as like one of those like operational costs, right? But what about like the inventory costs, um, I mean, like, what if some of these products that they sell start going down in cost? Like, for instance, like let's say electronics or TVs or whatnot. Like, for instance, from the macro environment, like Korea just like reduced their what was it, like their exports of semiconductors by 40%, right? Wouldn't that also have a factor on like other electronics that gets priced down also from like their console sales also?
Yeah, I mean, look, still, you just got to remember 86% of the company's sales are still console hardware, software, and accessories. So the vast majority of revenue still comes from PS5s, Xbox, Series X, the, the digital or physical copies of the software, the controllers, the cables, any other doodads. Them trying to upsell warranties, right? If you've ever actually walked into the store recently, you should, whenever you're buying anything, be getting asked if you want to protect your purchase, right? That GameStop is going to make a nice margin on upselling you there. So, to your point of if costs coming out across the ecosystem, I don't see video game software going in the other direction. I don't see them taking AAA games down from $70 to 60. And sure, could there be some gross margin expansion if costs coming out? Yeah. Um, but I mean, they're
Gotcha.
not really seeing like the big and bulky stuff. Like TVs, I think as a percent of their sales mix is probably negligible still. So they don't break that stuff
And
out, but just knowing historically.
And then one final question. So I actually got a smaller position back in when like GameStop actually did dip a bit because like I saw that what's his face Steve Cohen bought a small position, so like I got in just for like a quick trade. But what do you think? Do you have any opinions on that, or like why he did that, or any
No, I don't
ideas?
know. I mean, to be quite honest, I thought that the large pop was something that if you were willing to be a risk taker, it would be attractive to sell calls against if you want to take on a lot of risk. Uh, but yeah, I don't know people's logic. There's obviously a lot of these meme stocks are now being traded in different baskets of swaps, and who knows, who's hedging what when they're long shares or showing that they're long shares on a 13F. It's just I wouldn't read too much into any individual file, or unless they come out and step above a threshold and file a 13D and come forward with some messaging about whether they're going to be an activist or otherwise. I wouldn't read too much into 13Fs on some of the meme stocks.
Gotcha. Thanks, Rod.
Yeah, sure thing. If anybody else wants to talk about GME, always happy to. Otherwise, we'll keep it going and we can get to the more macro and bank crisis discussion. But did want to touch on this happened during last Friday's call. There was a Bed Bath and Beyond filing after hours, and we do still have it on the watch list for as long as the stock remains listed. We probably will. But there's like a lot of speculation out there in the Reddit verse about who actually was the participant in the deal that the company struck. You could call it a deal with the devil, if you will, that basically saved them from an imminent bankruptcy filing, but basically handed the keys to the castle of share issuance to Hudson Bay Capital. That's what it was reported in the media. There was a lot of folks who like to say there's no proof, there's no proof. Well, both last week and this week, the companies put out 8Ks sending a letter to HBC Investments, concern of Hudson Bay Capital Management, as the only recipient. So it seems clear to me that Hudson Bay Capital Management is the only participant in the deal. There have now been two of these preferred warrant waivers where there had been a price level at which the common stock needed to stay at. It broke down below that, what was first $1.25 per share and then was $1 per share. It's of course trading in the high single digits now, but the waiver is through April 3rd. So for another week or so, Hudson Bay Capital is able to keep churning through and trying to sell these securities. And again, who knows how they are precisely positioned in that they could have been just trading volatility across the chain because they were covered by all of these warrants that they received. Maybe they were selling these calls Again, who knows exactly, but we know they are the only party to the transaction, or to the securities transaction that occurred in February. And it seems to me like they're just running out of runway. The share price can only go, what is it, 9 cents or so lower before it breaks down below the minimum level in that deal. Yeah, if it closed at 82 cents, I think it was 72 cents is the threshold. So I think HBC is trying to sell as much as they can, and they're going to keep waiving this level. They have it waived, but I still think BBBY is probably out of bullets, depending on how much capital they ended up netting, right? We talked last Friday, I think that the filing had shown like they netted like 360 million. Is that enough for them, to restock their shelves, close these stores, get themselves situated for back to school season? It remains to be seen. But obviously, management is trying to, giving it their best foot forward. But yeah, I just wanted to point out that anyone who's throwing their hard-earned capital into some speculation that there's an M&A, imminent M&A coming from Bed Bath Beyond. I just think that a lot of people are clinging to hopium rather than trying to step back and objectively assess what's going on. And I'll be happy to be proven wrong if a white knight sweeps in and decides they want to buy the company. But after the deal with HBC, I just don't see why that will happen. So that's what I have to say about BBBY. If anyone wanted to talk a little about BBBY, welcome to. Otherwise, we'll keep it scrolling. Okay, not seeing any requests. So last topic before we kind of just open it up to broad discussion is really just the Fed decision this week, and the ongoing, if you want to call it a crisis. Yeah, we polled last week, Joe, right? And most people thought we were in a crisis still. I think it was like 80-20. I was in the view that the Fed, Treasury, and FDIC did effectively staunch a crisis by their swift, decisive action that they reached on, I guess, what is it, 2 Sunday nights ago, however long ago it was at this point. But that's where you've got now, they took these decisive actions to guarantee all depositors, including uninsured depositors, through the systemic exemption that they leaned on. But then you had the Fed chair being asked in his press conference, about depositors, and him effectively saying, all depositors are safe. And then you had the Treasury Secretary testifying to Congress around that time and not saying so. And then the market sold off big time. And then the next day, she added language to her prepared remarks that were, certainly we would be prepared to take additional actions if warranted. So you're in this weird predicament, sort of, where Congress is the one who needs to make any adjustments to the FDIC insurance coverages. If they're going to raise it from $250,000 to a higher level, that's a congressional act. The government agencies can step in a crisis situation and do what they did 2 weeks ago, but that's not going to fix, I guess, maybe this lingering uncertainty for uninsured depositors who are concerned that, well, what happens if there is no systemic risk exemption and my bank fails? Am I covered? I think it's going to be incumbent on Congress to act. And unfortunately, we have a very divided Congress, and I don't know that there will be any positive action on this front. Right, the name of the bank that failed most prominently is cannon fodder for one party. So perhaps if it were called Farmers Bank that failed, it might be a different discussion. But I think it is going to become more of a political football. I'm not so confident in our elected leaders' ability to look past that and perhaps pass some legislation that encourages confidence in the banking system. So that's one side of it. And the Fed did move forward with the 25 basis point hike. And we kind of said, if at least my view was, if there wasn't some escalation of the crisis after that had happened, that they'd likely still move forward with 25 based on Powell's testimony in the days before. the crisis unfurled, and they did that. They implied, you know, I think that this is probably the most clear messaging from Powell that they know they don't know what's going to happen next. And he said a few times, look, this is these are the median expectations at this point in time based on the information that we know. And it could always change, and it will change as new information comes in. But those expectations and the dot plot and the expected unemployment rate and GDP growth rates seem pretty misaligned with what's changed in financial markets in the past few weeks, right? The yield curve is pricing in rate cuts that the chair and the Fed kind of speakers have all said, no, we don't think that that's warranted yet. So the bond market's doing that, the rate market's doing that, and the Fed is still saying they think that they need to stay higher for longer. So there's that disconnect. That's somebody's going to be right, somebody's going to be wrong. And of course, if we knew with certainty who was, we could probably bet accordingly. But I struggle with seeing the Fed raising another 25 basis points unless we get some very surprising accelerations in underlying economic data. The job market is still strong. The continuing and new unemployment claim levels are still, pretty low, flat. And you're not seeing some big deterioration. But as Powell noted, the effect that they should expect from this credit event is that there should be demand destruction. There should be a reduction in credit activity and a reduction in demand. And they don't know how much so, if at all, there will be. So if there is, then that would mean they don't have to raise as much because the effect of that credit tightening would be akin to the rates going higher. And yeah, I think that he was very clear that they know that things can change and things can change quickly, and that what they put out for their summary of economic projections was the most likely path that each individual participant saw as of this point in time. And it's still too early to know if, as I kind of think, the crisis is probably contained and that maybe the impacts are not as widespread as others might think. And of course, if there's some further escalation, right? While we were having the discussion last Friday, we talked about the UBS Credit Suisse situation. I think I used the term shotgun marriage, and I think that's a appropriate characterization. UBS didn't want to buy Credit Suisse, but they were pretty much given, if you don't, then things are going to blow up, kind of. So they ended up buying it, right? And then we had this really peculiar outcome where Credit Suisse common equity holders got something, but the AT1 creditors got nothing. As the Willy Wonka meme, you get nothing, good day. So these credit instruments would be completely written down if there were a viability event, which is what the regulator determined. So now the question from that is, reasonably, should all of these similar instruments have higher yields? Are they worth less? So the prices need to come down and yields need to go higher on these instruments because the risk is that some other European bank is going to implode, and that these creditors are going to get wiped out in some sort of a government rescue again, which I'm going to put up. I think I had a good screen on that one from Wall Street Journal, good graphic they put out this morning, just kind of showing that most of those AT1 bonds are European issuances, since they kind of came into being after the financial crisis. And what's the enduring impact to this asset class for these bonds? I don't know the answers to that one, but I think the journal write-up that had some good graphics and kind of visualization to understand what may happen there. But okay, that's kind of all the prepared remarks discussion that I had. Happy to open it up if anyone wants to talk about any of those topics or any other ones. There's one other comment then before Chris comes up on the AT1s. This was from Bloomberg Intelligence. Their takeaway was that, um, given the treatment of the AT1 investors, quote, this may have knock-on effects further up the capital structure in terms of lower investor demand, higher spreads, and increased cost of funding. So that, again, remains to be seen how this plays out. If there are any other banks will go under, but that's clearly one byproduct of the Credit Suisse UBS shotgun marriage. But Chris, always nice to chat. What's up, man?
Hey, how's it going now? Happy birthday.
Thank you.
Can you hear me?
Yeah.
Disconnect this. Oh, can you hear me?
Yep.
Okay, yeah. I was gonna ask if you guys have I kind of been in and out, for a little bit, but did you guys talk about the Altria meeting today, the investor day?
We didn't
For
talk
Altria.
about Altria Investor Day. I haven't actually gotten caught up other than seeing some of the images from it. I think a takeaway is they're going to be investing more in non-combustibles, which we'll see. We'll see how the Enjoy purchase pans out. And I heard them talking about like caffeine pouches and other non-nicotine products.
Oh wow, that's interesting. I didn't hear about that one, but I think the big takeaway is that they this is the first time they've given I think they said 5 billion by 2030 or something like that. Like how much revenue of non-combustibles they'll do. They give an actual figure in terms of their target for the non-combustibles business as a separate segment. So yeah, I guess that's like a kind of like just a turning point for the company and for the industry in general. But yeah, I'm not in Altria at all, but I've been following the tobacco space as you are definitely aware. But yeah. And any other thoughts?
Yeah, so the 2028 goal, the 5-year target was to grow total smoke-free volumes by at least 35% to reach 5 billion, of which 2 billion will be from innovative smoke-free products. So I think a chunk of that, right, is going to be your traditional oral already. So, when they say smoke-free, you've already got like the Copenhagen and whatever other brands they own offhand. I don't know all of Altria's, but so it sounds like 3 billion in smoke-free from traditional, and then 2 billion from innovative, like nicotine pouches and e-delivery of or vapor or heat not burn, which I know they don't get that product until 2026 with their partnership with Japan Tobacco. So, but you're right. It's the first time I think they've given specific targets. As you know, and for those who listening might not know, the market has rewarded Philip Morris, which is the international spin from Altria. Altria does market Marlboro in the U.S., but PM markets it internationally. And Philip Morris's multiple is much wider than theirs. Philip Morris has a 30-ish% of revenues from non-combustibles. they just bought Swedish Match, whose Zyn product is very popular and leads, is the leading market share of the nicotine pouches in the U.S. So like PM gets that commanding multiple because of smoke free, and clearly both BTI and Altria would love to see their multiples expand like that and are investing. Altria I think behind the other two, but yeah, maybe they all sold off yesterday with the view that the profit pool is going to be challenged by those three, cutting each other off at the kneecaps. And I think I've mentioned this before. BTI is in my personal account my largest position. And when I look at the forward return profile of a lot of these tobacco companies, I think that they're all pretty attractive by and large. I personally prefer BTI of the large ones, just based on the, I think, misappreciation of their reduced risk products portfolio, which again, we'll see how Altria can close that gap.
Yeah, I think there's a big, from what I've read online, mostly on Twitter, actually, these tobacco people are really thorough when they talk about this stuff. But there's a big difference between the formulations of these pouches in America versus like in like, for example, Sweden or in Europe or other places, because the FDA has the PMTA thing. And I think the last approval for one of these products was like in 2016. So like I think Zyn is the only one that has like the approval to like do the nicotine salts in their product. And these guys like Velo with British American Tobacco, and then Altria is on, and these other smaller guys, they're stuck using an older formulation that's like, I guess customers don't like as much. And people that come here from Europe, they're like, oh, your guys' stuff is like not good. So I guess there's this sort of hope that maybe the FDA will, approve some changes, right, to these products, because they're kind of very, hesitant to do that these days. But if they realize that the risk of, people smoking cigarettes is, high versus these other safer alternatives. But it's not going to go easy, I think. I mean, with this, there's a lot of nicotine in these things, and the current administration really doesn't like it. So we'll see how that unfolds.
Well, it's also interesting because you have stuff that's very popular, like Elf Bar, which these smaller, players are elite. They're selling these things without any, pre-market tobacco product marketing order. They don't have approval to market these, flavors of nicotine vapor products, these disposables. But because the enforcement hasn't been to date, I guess, pretty significant against them, they're getting a lot of. So it's like the big players can't skirt the rules, right? The BAT, PM, and MOs can't go and sell flavored products, like that. But these other small, Chinese manufacturers are flooding the market with illegal product. So the steady state that I kind of hope to see is where there is enforcement, it kind of becomes a regulatorily enforced oligopoly where the big players kind of retain most of the profit pool. The worst case for them would be that you don't get enforcement. You continue to have black market and quasi black market sale of competing products. The big players can't sell those products, and the FDA continues to deny any menthol flavors for electronic nicotine delivery systems, vapor, which they've continued to deny thus far. So there's definitely downside risk to any investment thesis. That's some of the risk I think that faces some of the incumbent big tobacco players, at least in the U.S., which the U.S. Has the largest profit pool, which is why it's discussed the most. But Philip Morris, right? They have approval for their heated tobacco product. They have the PMTA for IQOS, and which Reynolds is trying to catch up. Reynolds, which is BTI, and of course Altria just bought Enjoy, which had gotten approvals last year for their Enjoy, a couple of the Enjoy products, which those approvals are clearly worth a lot to big tobacco because they are not fast and they're not cheap to get, and that's why I think Enjoy was purchased.
Yeah, I'm just really, just after looking at this for a while, like just how it's possible for all these like Chinese companies to just like flood the market with these vapes. And like what is customs doing? I mean, like how you're able to import that? I mean, usually when you import stuff, like you have to declare it, and if it's like some sort of drug or some sort of like nicotine device, I mean, I guess there's a kind of a loophole, but I'm wondering if maybe the big companies try to get the FDA to like be more fair with enforcement.
Yeah, because you're right. The prior administration's angle was definitely different than this one's, and for these long processes, it's just an additional risk for these companies. Yeah, I don't know like the ins and outs of why they continue to get away with selling these products illegally without much enforcement. I just don't know the enforcement regime in and out, but yeah, I do think that, as I've mentioned, the entire tobacco space remains very deeply discounted just in the context of there's a whole lot of cash flow that will continue to come in for many years. And even if SIGs are in long secular decline, you know, even so, those cash flows will continue for decades to come. And when you're getting paid an 8% dividend yield, and your forward PE is less than your dividend yield, and you have a consumer staple product that people don't have a lot of price elasticity, yeah, I think it's still a pretty attractive business, actually. It'll really be interesting to see how there's different like consumer behaviors around in whether people like vapor versus the heat not burn versus oral tobacco or nicotine products. So I'll be interested to see when that IQOS product does come back stateside. Basically 13 months from now, it's April 24. They can begin marketing it, and they'll be able to market it, Marlboro branded, heat sticks, whatever. So definitely, that's a big risk to Altria and to BTI if Philip Morris is able to come in and start to really take a lot of share with that product. But from kind of to your point about the guys who've done a lot of work on this stuff, they've noted that just the consumer habits around using that sort of product do vary meaningfully between Europe and the U.S. And I don't think most of them think the uptick in the U.S. will be comparable to Europe. But of course, there's always uncertainty. All right, what else? It's 4:55, so we could definitely wrap it shorter this week if nobody else wants to come up and chime in. I'm trying to think of what other big topics happened, but I think the big thing is what happens next.
I guess I could ask Rod. Rod, have you made any trades this week?
Yeah, I bought more BTI most days this week. I bought PBF Energy a couple days this week. I think I mentioned this last week, but I continue to believe that the refiner space is a lot of these refiners are still pretty cheaply priced. Refining cracks are still elevated, which is why your gasoline, even though oil is back below 70, that's why your tank of gas at the pump is still over $3 a gallon. on average, right? Because the refiner's crack spread above the cost of crude is where that's coming from, and there's not volume. Supply levels are still very low for distilled product, gasoline, diesel, jet fuel. Those inventory levels are still pretty low. On the capacity side, a lot of the refiners have just been running all out. So there's a lot of planned maintenance, and the refining space, there's just, again, people aren't really investing into it because the current administration keeps trying to say, we don't want you to invest into it, but then we want prices to go down, which can't go down unless you invest in it. So it's a weird world we're living in. Fossil fuels will be around for decades to come. And, it's just an ugly industry. I like investing in disliked industries. I'd much rather buy something that's disliked that produces a lot of cash than buy the shiny object that maybe those cash flows come to me a decade from now. I bought EC, which is a Colombian integrated oil company. I added to my position there, as well as Petrobras preferred stock. I think, again, I tend to think that the sell-off in kind of the oil space and the refiner space is overdone, because I think the market is trying to front run a real nasty recession. I don't really think that happens. And even so, the valuations are so undemanding with how little investment continues to go into oil and gas broadly from a production and refining perspective, that I don't need to really worry about prices completely collapsing, which anything can happen. But I think it's attractive if you're underweight to take a look at kind of the energy space and of course the tobacco space. But I understand why people wouldn't touch them. What did you buy this week, Joe? I'll take silence as you didn't buy anything. Chris, what about you?
I bought some BTI. I bought a copper producing company. They're not really like a miner. They more like they kind of refine it and stuff. It's called China Non-Ferrous. It's a state-owned company, partially state-owned, but yeah, I think commodities are going to tick up. What else? I haven't really bought a whole lot this week, but I bought some Nordstrom this week.
What's the
that one has
thinking
come
there?
down quite a bit. I like the valuation right now. I think it's trading at around 10 times earnings, and I think they're going to do okay. I think they're a good company. And of course, like Ryan Cohen, I mean, maybe he talks about it again, and then it's a small position, but I think, there's a, asymmetric sort of upside situation with that, involvement. That was my reasoning, and I'm selling some puts on it, so I just want to generate some premium. I don't know, have you been following it much or not really?
I haven't really. I don't really love the retail space right now. Unfortunately, I closed out of my XRT puts when Bostic gave me the head fake, which is regrettable.
Yeah. Activision ticked up today. It's up 6%.
Yeah, I saw
because
somebody was dropping their opposition to the merger.
The UK regulator, the CMA.
Okay.
the UK regulators, they changed their they had a change of heart. They said that they're not so worried about Sony's complaints.
So here's another ticker. I didn't buy any of it this week, Joe or Chris, but it it has some impending catalyst. It's also a refiner. It's Vertex Energy. I think I've mentioned it. I know I've mentioned it at least in the open mic, but they acquired Shell's Mobile, Alabama refinery for a very low price, 75 million. In they closed on it a little over a year, around a year ago, and they have a renewable diesel hydrocracker conversion that the mechanical completion is due to be complete by the end of this month, and it's supposed to begin production of renewable diesel, which they have a 5-year offtake agreement into the California market already in place. So that renewable diesel really helps them kind of just from all of the all of the government money that is plugged into renewable energy, the RINs, they can reduce those costs for their conventional. So that is again another refiner that I have a position in that has some imminent catalysts that will hopefully assuage some of the concerns. Trades at I mentioned PBF, and between PBF and Vertex, I both with both of those I have a low mid single digit position, and it goes back to like forward looking PBF, very cheap on forward looking basis. It's trading at like a 2 point high EV to EBIT multiple for next 12 months. Vertex is not quite that cheap, although if you believe that they will succeed with this renewable diesel project, then it's going to get really cheap really fast going forward. So how that pans out versus what's priced, of course, is the $1 billion question. But when I look at Vertex trading at a 3.2 times next year EBITDA and a 3.7 times next year EBIT per the analysts that cover the company, and a 3.9 price to earnings for 24. So, assuming the project succeeds, which you have that catalyst coming imminently, I think that the stock could pretty rapidly rate up into the teens. And I think fair value is higher up into the teens, but it's trading at eight and change right now. And the 1 year forward PE is 5.5. So again, this one has a lot more idiosyncratic risk, I think, right? Because the project could not be successful. It's one refinery, or at least one conventional refinery, whereas a PBF has multiple. But just another part of the energy space that I find interesting.
So do you think oil prices don't meaningfully drop any further this year, or like what's your take on that sort of macro situation?
I'm not at all an oil market specialist, but I would struggle to see oil below 50 per barrel for any extended duration. I mean, it could always dump precipitously, but global demand for oil is only going to continue to rise. And even if there's a global recession, as we trot out what happened in the GFC, oil demand barely went down. So demand for those products, and it's not like people are again investing massively into new projects and into capex. So because you've had a pretty minimal investment cycle for several years now, it's not like there's just oodles and oodles of producers trying to sell at any price.
Mm-hmm.
And it's interesting, right? Because oil is priced in dollars, and if you think about it, $70 per barrel in 2023 is a lot less than $70 per barrel, in the mid 2000s, and in the 2010s, with inflation. So, oil. It's obviously, again, I actually do think commodities are pretty attractive broadly. And again, if you think there's going to be a big global recession, then sure, it would make sense that they'll come down in price. But I don't.
Yeah, I mean, I think with inflationary periods, you have these periods where prices spike up and then they come down and then they spike up again. Like, it never just happens that they're just like one spike, right? Usually, I mean, correct me if I'm wrong. I mean, a lot of times, there's just a lot of things can happen on the way to experiencing high inflation. But I mean, I guess the Fed is really taking action by raising rates. I mean, some people may argue they're not raising fast enough. Some people want them to cut now, but yeah. I mean, I guess I'm not really like, I don't really know a whole lot about macroeconomics to comment on this kind of stuff. But
look, I mean, this is right. This is where the Fed is I think, being very honest that there's a huge amount of uncertainty now in the outlook introduced by the crisis, and the expected outcome of the crisis will be a pullback in lending and credit markets, tightening, and therefore there being less demand, and that should all act to be deflationary. And it's, to what extent? No one knows to what extent. It will impact things. The underlying, as we keep talking about, the underlying job market still remains pretty tight, and there's some stuff coming in short order. I think I mentioned it last week that, like, by the end of this month, anybody who's been continuing to receive Medicaid because of the pandemic extensions will effectively, some may need to re-enter the labor force to get health insurance coverage because they will no longer be eligible for Medicaid coverage. So will you see some supply re-enter the labor market in the coming weeks? To what extent will that supply be meaningful? The flow of immigrants has ticked up, thankfully, and that's helping. But will we continue to be able to get some supply alleviation so that the demand destruction doesn't have to be maybe as severe? And that's, I guess, a hopeful angle to look at. And then, on the demand destruction side, I do think it's hard to understate what happens when a lot of these younger borrowers who are already a little more stretched than others, the Gen Zers and maybe my peers in the millennial group, have their student loan repayments turned back on in 3 to 6 months time. What does that do to their discretionary spending levels? I have to think there is an impact, and the question is just how severe. I mean, in the big scheme of the U.S. economy, the 60 billion a month or whatever it is not massive, but we just don't know, is it half of that that's currently not being saved, and is instead being spent? It's really hard for anyone to know that. So there's some stuff happening in addition to the crisis that just makes it even more uncertain. It all goes back to, we came out of a once in 100-year pandemic that it didn't destroy the factories like a war would. It didn't destroy people's capacity to work like again, if it had been a war. So it's just been a really weird time, and that's why the things that I'm interested in are things that I know will be around for years to come, and that are pretty cheaply valued on most valuation metrics, like tobacco and refiners. But otherwise, again, cash is paying you a nice yield. Just make sure you have it in an insured deposit or in treasury bills. Anyone else want to come up and share any thoughts or trade ideas that they've been coming across? All right. Well, I'll wait and I guess take the pulse. If anyone does come up, we can keep it going. Otherwise, I'll kind of note some programming notes. So on next Tuesday, so on the 28th at 8 Eastern, we're going to have our next iteration of our Wook Book Club. Will be on Spaces. The Wook team will be there, and anyone who had decided to read the book or who is interested in hearing about the takeaways from the book is welcome to join in the discussion. We're going to be talking about Joel Greenblatt's The Little Book That Still Beats the Market. It's a really simple read. It's targeted for anyone who, as like a first step into investing. Chris, I think I saw you note it was the first investing related book that you ever read in the GME DD server. I think I saw you said that. So it's a great for even if you're a seasoned investor, it's I think great just to kind of think back to the very core principles that Greenblatt is trying to get across in the book. And I hope we have a good discussion about it. And I'm looking forward to that on Tuesday. We'll be back with our regular weekly open mics that we've been doing on Wednesday nights. Obviously, we didn't do it this week because I was too busy being drunk at the casino. But we'll be back at 7 o'clock on Wednesday night next week. And we'll be back with our Wook and Review next Friday at 4. I don't want to tease too much. There's some exciting integrations that Joe and I have been working on, but I'll leave it at that. And I'm hopeful that we, in the very near future, can share some of that stuff with everybody. We're excited. Even if, my voice doesn't sound that way. I'm just a little worn out.
Yeah, Rod, you did well at the casinos, didn't you?
Yeah, I told the team in our little meeting last night, my girlfriend had a very lucky streak. So our favorite game is craps. It's a fun table game to play with dice rolling. But she made a very lucky side bet that I won $750 on a $5 bet. It's basically you as the shooter need to throw 2, 3, 4, 5, 6, 8, 9, 10, 11, and 12 before a 7 comes out. And she actually did that 3 times, not consecutively, but over the course of the time we were there, the true odds of that happening are 189 to 1. So, the house edge is real. I got paid out 150 to 1 on my $5 bet, but that was the bulk of my profit for my casino experience. But it was fun, right? It's always fun when you see these goofy, unlikely things happen. So, and what's more important, right, is if you're ever going to gamble at a casino, you should go into the expectation of losing and treat it as an entertainment expense, as I do. And I was pleasantly surprised to come home with more money than when I left. So, had a good time. But I think we can cut it there at 5:15. We'll be back then on Tuesday night. Hope to catch some folks at the book club. Thanks again, everybody, for tuning in. Again, just so you kind of know, we're doing this, not because we're trying to ever sell people on a product or service. Our hope is to, over time, build a really knowledgeable investor community and network that we can all kind of tap into to crowdsource research together. And that dovetails with what Joe and I are working on. And hopefully we'll have more for you soon. But cheers, everybody. Have a great weekend. Thanks so much for tuning in, and stay safe out there.